Not able to. There, thank you. So the first slide here is about L1 Intracompany Transferees. This is going to be the scenario where there is a company that's already established, usually somewhere outside of the US. Like say you have a company in China or Hong Kong, or Singapore, Taiwan, what have you. There's a company and they may or may not have an existing related entity in the US. And so, if they have a related entity, it's usually some qualifying relationship. If they don't have one, then usually people come and they look at possible locations, what kind of business they want to do. They do some market research, and they set up either a parent subsidiary relationship where the company abroad owns at least 51% of the U.S. entity, or sometimes you have a U.S. company that opens up a subsidiary abroad outside of the U.S. So sometimes U.S.-run companies say, hey, we want to open up a subsidiary in China, or Hong Kong. And so that becomes a subsidiary. Sometimes you have multiple shareholders or owners of a company, and they want to hold them as affiliates, where it's like brother-sister company, and both entities have the same set of parents, basically, but each shareholder owns the same percentage of stock in the two entities. At times, there are companies that have, they have offices all over the world, and that would also suffice for an L1A. The beauty of an L1A is that it gives a lot of flexibility for people to come and do business. It has to be an active business, meaning you can't just park your money and do nothing with it and grow it. It means that if a company is being set up, the most common scenario is a company outside of the US setting up an entity here. They need to incorporate, have an actual, location. They need to hire. They need to start bank accounts. You need to hire, at least a business attorney, have a CPA. You need to have all these things and intend to hire employees and be imminently ready to do business. And the money invested has to correlate with the kind of business that they're doing. So you have a business that's going to be, say, manufacturing semiconductor equipment. It's got to be substantial investment. 100,000 is going to be nothing. I mean, it's going to be like hundreds of thousands, if not millions of dollars. Sometimes people ask, well, how much can I invest to start a company? It depends on your business, the kind of business. If you're going to be importing, exporting fake plastic flowers, the investment will be less than manufacturing tech equipment. If you're investing to start a business in California, in the Bay Area, you will require more money because rent will be higher and salaries will be higher. Whereas if you compare and you invest in the middle of Ohio, Wyoming, that amount would be substantially less because the cost of business is less. For an L1, it does matter the size of the company. There's all different sizes of companies. We usually advise if the company is too small. Being too big is never a problem. It's when they're smaller, we want to see, look, how many employees do you have? How big are you? What kind of people are in your company, so we can see if they qualify for an L1 and then tell them what needs to be done in order to have an L1. Sometimes companies are not ripe for an L1 status. I tell them, look, you need to hire some more people in your company abroad, or if they don't need that many employees, they have to explain why. How does their business model affect this? I usually ask for a 5-year business plan to explain to the government so we can submit that with an application of how they're going to conduct business and what kind of jobs they're going to be growing and what kind of investment. Who qualifies? People who are executives and managers. And one of the other things besides the actual business and and investing money is that these individuals who would be transferring over have to work at least 1 year full-time status, continue in the company abroad outside the US for at least 1 year before they qualify to come to the US. You have to be on payroll. So if you have a company outside that's too new, I tell them, or the person joined not long ago, I tell them just wait or send someone else, have them work there for a year before they qualify to come here. So you have the company qualification and the ownership, you have the individual, you have managers and executives. So you need to manage other people who are either professionals or supervisory people, or manage a function that could be like a project worth lots of money. Specialized knowledge applies to people who have some proprietary knowledge that this company has that no one else has. And they're coming to the US to share that information, to bring it over here so that the US company knows how to use that and to train US workers how to use this information. Typically, the L specialized knowledge is good for up to 5 years. The Immigration Service is not going to give you 5 years up front. They'll give you 2 or 3 years at a time. And managers and executives get upwards of 7 years. And again, to give you a few years at a time. If it's a startup company, you get 1 year up front and it's extendable. Let's move to the next slide. So the US has treaties with various countries around the world. And here you see a bunch of alphabets, E2, E3, H1B1, and TNs. The next slide. So this is in a nutshell. So in terms of E1, E2s, if you look up or Google, treaty countries or US Department of State, treaties, there's going to be a long list of countries we have treaties with. And these are treaties of navigation, friendship, and commerce that the United States has with countries around the world. Some countries fall under E1 and E2, some fall under just one or the other. For example, we have a treaty with Singapore, we have a treaty with Japan, we have a treaty with Taiwan, Canada, Mexico, most European countries. So, we always look to see if there's a treaty. The reason why is if an individual or a company says, we're going to invest a certain amount of money or we're engaged in export-import, I'm going to look to the treaty for some flexibility. Why? Sometimes they may not have a company outside the country to do an L1 to transfer them. It might be someone saying, you know what, I left my old job and I have a boatload of money. I'm going to invest and start a company in the US. I'm like, good for you. Let's see what country you're a citizen of. The treaties go by country of citizenship, not country of birth. So I always ask people, do you have more than one citizenship in different countries? You can have dual or triple citizenship depending on what the countries allow. E1 has to do with substantial trade. So in this instance, there would be a company in the country outside the US, and there would be an existing company where that company and the US does more than 51% of its import-export between those two countries, and it's got to be substantial trade. Substantial, there's no dollar sign. Sometimes it's based on volume. If you're importing, exporting, say, high-tech equipment, that's going to be based on a really high value. You're importing, exporting rubber gloves, say used for surgery, that's going to be based on volume because rubber gloves don't cost as much as these, high-tech equipment. And then and again, you have to maintain that level of trade for import, export all the time. For the E2, in comparison, it could be any kind of business. It doesn't have to be import, export. Someone can invest, into a business here from any country, and they could start up a filmmaking business. They could start up a restaurant. They could do many things under an E2, but the investment has to be enough. And again, we have to show a 5-year business plan so that the US consulate or embassy that grants this visa will believe it. And it has to be enough of an investment. I tell people, don't make it all the money you have in the world, because the officer might ask, do you have any other capital or money in case this is not enough to carry the business? And the business needs to be owned at least 50% by someone who's a citizen of the treaty country. So there's a lot of strategy between when we pick between, what different kinds of visas and what are the limitations and what's the flexibility. The beauty of the e-visas is they're renewable indefinitely. I have some clients that have e-visas for like 15, 20 years, because guess what? They don't want to stay here. They come in and out for business. They're very global and they don't want to get green cards. And typically it's for some kind of tax reason, which Peter can talk more about later on. Australia has its own treaty with us for E3s. These are for professionals who have a bachelor's degree in some specialty occupation. So I know that oftentimes we have just Australians, or sometimes we have people from other countries who have citizenship in Australia. And that's always an option too, for someone to come over here. We have a treaty with Singapore and Chile. It seems odd that we have one treaty that covers those two countries because they are so different from each other. But this one treaty, the H-1B one, applies to Singaporeans and Chileans. And again, they're for professionals with bachelor's degree. And they can come over here and work. It's an option if they have this particular country's citizenship. Last under the treaties that I'll talk about is TN. So we have the North America Free Trade Agreement between Canada and Mexico. It's called Nafta. They allow professionals into the US. There is a very specific list of occupations, everyone from engineers to veterinarians to come in here and to do work pursuant to that treaty. Canadians apply at the port of entry at the border, and Mexicans have to pick up a visa at a US consulate before they get into the country. And these are renewable as needed. Let's go to, and these are visas that have temporary intentions, meaning they're for a very limited period of time.